Welcome. You have reached Module 4 of Women in Finance. In Section 1, we are going to talk about financial statement analysis. So let's get started. All listed companies must publish their financial statements quarterly. This is mandated by the Pakistan Stock Exchange and the SECP. You can find these statements on the company's websites and under Investor Relations or on the PSX data portal. These financial statements are audited by third-party firms such as PwC, EY, KPMG, and more. Financial statements are a goldmine of information about a company's performance. There are four main types of financial statements: the income statement, the cash flow statement, the balance sheet, and the statement of change in equity. These statements are crucial for financial analysis and valuation. Let's start with the income statement. The income statement tracks the company's profit and loss. It outlines revenues and costs and categorizes them to understand the source of profits. The first cost item is COGS, the cost of goods sold. For instance, in a food business, COGS would be the cost of ingredients. The gross profit is the difference between the revenue and the COGS, and it shows the profit a company makes before deducting operation expenses. It indicates how much profit a company makes on each sale. Operational expenses include regular operational costs such as rent, utilities, salaries, advertising, and more. EBIT, or earnings before interest and tax, is the difference between the gross profit and operating expenses. It represents the profit from regular operations. EBITDA, or earnings before interest and tax, depreciation and amortization, is a good representation of a company's cash earnings. Depreciation and amortization are non-cash expenses, and they spread the cost of a long-term asset over its useful life. For example, if a company buys a machine with a 10-year lifespan, the cost of that machine will be spread over 10 years. This is called depreciation. The net income is the final figure on the income statement. It represents the total profit or loss after deducting all expenses and taxes. Now, let's just touch on dividends and retained earnings. Dividends are a portion of the profit that is given to the stakeholders by the company. On the flip side, retained earnings are profits which are kept by the company as a financial buffer or for expansion. Financial statements are crucial for investors to evaluate a company's financial health, and therefore they help you make better informed investment decisions. So, until the next lesson, happy investing.